Good afternoon, everybody, and welcome to today's live event from Interactive Brokers. This is Andrew Wilkinson, Director of Trading Education. I'm here running the webinar program, and I'm delighted to have with me Jack Schwager, who's the co-founder, author, and trader of Market Wizards, and today he's head of Fund Seeded Technologies. Welcome, Jack. How are you?
I'm great this morning, thank you.
Jolly good. Well, you're going to be talking about Market Wizards, and I think you've kind of you've not necessarily moved on from being an author, but these days with Fund Seeded Technologies, you've set up something a little different. You're looking for traders, right? So tell us a little bit about today's discussion. You're going to be looking for traits, common denominators of a Market Wizard, right?
Right. So essentially, this presentation is a combination of a lot of the key things I've learned by doing these interviews with great traders over the decades now. Actually, five Market Wizards books and working on a sixth at this point. So so this is a compendium of a number of the important lessons. Not all of them, but a lot of the important ones.
Very good. Okay, I'm really looking forward to seeing today's presentation, and just for the benefit of the audience, you'll be able to see the recording of today's event with Jack a couple of hours after we've wrapped up talking today. You'll receive an email in your inbox. There are no handouts for today's session. This is proprietary from Jack, so there's no actual handouts, but there will be a chance to ask questions through the chat panel later on. Jack, if you wouldn't mind putting up slide 2 for me, just so that we've got the disclosures in the event we're talking. We hit upon risky assets and so on that my compliance team likes to point out to attendees to these webinars. That's great. And if you can go on to the opening slide, I'm going to hand over the microphone to you and we can begin.
Okay, you let me know when you're ready.
Off you go.
Oh, okay. Are you ready for me to start?
Yeah, please. But we've lost your screen. There we go. I'm just going to enlarge that. There we go.
Okay. Good. Yeah. It's just that problem. Okay. So let's begin with a basic question. Can the markets be beat? So there are plenty of people out there that are telling you that it's a fool's game. And to illustrate this, I know an economist, Yoram Bauman, and he's authored some books, a cartoon introduction to economics. Actually, a pair of books, and they're actually quite good. I mean, for cartoon illustration books, they get a lot of the key things of economics. And he himself is called the stand-up economist, so he does these comedy routines on economics, if you could believe it. You can check it on the web. I think he's pretty amusing. I think he's pretty funny. Anyway, in this book, in one of his books, he's illustrating the efficient market hypothesis, and he uses a very good illustration, I think, which is a traffic jam. So you're in a traffic jam, and you can keep switching back and forth from lane to lane, and after half an hour, you're still next to the same car. So his point is that's what trying to beat the market is like. You could try all these things, but you can't get ahead. Everybody's in the same situation. There's nothing you can do to really get ahead. And I said, that's a good illustration, Yoram, but there's one thing that you're missing. And I said, the key thing here is that, my thing suddenly is not advancing. I am sorry here. I don't know why this is happening. My slides are not advancing. Maybe I need to go to a different view. I don't know. Did anything change, Andrew, on before they were advancing and now they're not? I lost control of it?
No. Let me just double check. You are still the presenter. Yeah. You know what?
Jack,
let me.
Clicking on the slides.
Clicking on a slide? Oh, okay. You have to click on the slide itself. Okay, that's all right. I wasn't familiar with that particular way of changing slides. Okay, so I said, what you're missing is that not all highway users are equal. So here's a obvious situation. So everybody, yes, everybody has the same jam, but not everybody is in the same position, because some people are going to be better in handling that particular situation. Just like the motorcyclist here, yeah, he is able to advance despite the traffic jam. And the point is, not all market participants are the same. Yes, they all have the same information, they all face the same conditions, but there are going to be some people who are just better in using the same information. And as another illustration, take a chess tournament. All the participants in that chess tournament have access to all the chess books. They know all the basic strategies. They all have the same information, but you'll have somebody like a Magnus Carlsen who crushes the competition. So the fact that everybody has the same information, that all information is known instantaneously by everybody, does not mean the markets are efficient and you can't be beat, because some people are going to use that information more efficiently. Okay, so I'll begin here before going to what's important. I always like to go for what's not important, because a lot of people are under the impression that being very successful in the markets, it's about finding some secret formula, whether it's some GAN thing or Elliott wave or whatever. But there's some magic formula out there that you find that and it'll be a money machine. And the thing about it is that I was struck from the very, very first book I ever did on the Market Wizard book, was that all the traders kind of using different approaches. Almost no one is the same. And just to illustrate how different the approaches are, I'd like to use two people I interviewed in the first Market Wizards book. First is Jim Rogers. Rogers initially was George Soros's partner, and very successful in the early years of the Quantum Fund. Left to be a private investor and has done very well over the decades on his own. Anyway, I asked Rogers is very much of a fundamental long-term guy, basically. And I asked him, hey, do you ever look at charts? And he said, yeah, if I want to know just like the history of where the market has been or something, maybe, but do I believe in any of this head and shoulders mumbo jumbo? It's all a bunch of nonsense. And he says, I never met a rich technician. And then to be cynical, he adds, unless you count those who sell their services. So that's his view of technical analysis. You can't get more extremely negative on it than he is. And the other year, in the same book, I interviewed Marty Schwartz. Marty spent a decade or so as an analyst, a fundamental analyst, and he says, and he was, to give you an idea, I mean, Schwartz was enormously successful. At the time I interviewed him, he had a record of like 25, an average return of 25%. And whenever I say that, if I give it to a live, or if I say that to a live audience, I see nobody's impressed until I tell them it's 25% a month. And then there's a lot of skepticism. Wait a minute, 25% a month, compound that's ridiculous. You're going to get half of the US GMP. So the thing is, though, what he did is he didn't compound. He would enter these trading contests with $400,000, double it in 4 months or something like that. But and just kept repeating this process over and over and taking the profits and banking them T-bills. But he did have this extraordinary track record, and he only had like 2 losing months in that whole period. The worst one being, I think, 3%. And he said the 2 losing months were when his children were born, so he had an excuse. Anyway, so he's somebody whose opinion matters quite a bit. And he said, I spent 10 years, fundamentals lost money every year, and I got rich as a technician. So there you have like 2 extraordinarily opposite views, and they're both very successful. So that is a perfect illustration that there is no single way to beat win in the markets. There's really my own. I'll quote myself here. One of the few times I quote myself, but one of the lines I use in the book is, there are a million ways to make money in the markets. Unfortunately, they're all very difficult to find. But there's a lot of different ways, which brings us to what way should you choose? And this really comes down to different methods are going to be right for different people, and you really have to find the method that fits your personality. Again, I think this is best illustrated by using actual people I've interviewed. And for this contrast, I'll start with Paul Tudor Jones. I interviewed Paul Tudor Jones. He said, come to my office at 2 p.m. and I say, hey, Paul, I know you're an active trader. Like, maybe it's better we do this after the market closes. And he said, nah, come on, just show up and it'll be fine. So I come to his, his office, and this is back in the day where we had, this is back in the 80s, we have trading pits, and, before electronic trading, and Paul's got multiple screens. He's got squawk boxes to like every main floor. We're doing the interview. He's shouting out orders: buy 100 these crude, sell 200, August gold, whatever. And so while we're doing the interview, he's still focused on the markets and trading wildly, or not wildly, but actively. He's got people coming in with messages. He's doing all these things, and he's doing the interview. So that's Paul. Kind of very energetic, almost frenetic in terms of as a trader. Picture John McEnroe as a trader. It's sort of that type of image. On the other hand, there's another person I interviewed, and I believe this was in the new market, was the second, Gil Blake. And Gil Blake, he was basically an unassuming CFO, and if a colleague comes in one day and say, hey, I found this, you're a numbers guy, and he showed him this thing where he was switching between stock mutual funds and interest bearing funds, and he was making money. He was doing well on it, and Gil was kind of cynical about it. And he says, hey, I'm sure there's something wrong with this. Give it to me, I'll check it out. Anyway, he did check it out, and it did seem to hold water, and that got him intrigued. And he started doing research, and he basically came up with these. He would go actually to libraries and go through microfiche film of prices and look for patterns. And he came up with these patterns that he discovered for doing the switching. Now, market timing eventually got a bad rap because people, I won't get into the tangents of it, but people exploited it. But and they were entering orders past market hours and things of that sort. But this has nothing to do with this. He was like I believe the first person to come, to do this. And he just found patterns, and he was trading those patterns. And he had a 12-year record when they interviewed him. His sharp was like 5, something like that. He had worst drawdown of 5%, an annual return of 45%. So he was doing incredibly well doing this. Anyway, he was a very shy guy. Didn't want to manage anybody's money. Didn't want to talk to anybody. Would basically trade from his bedroom. Very, very low key, very quiet. And I tell people, can you imagine? Paul Tudor Jones trying to trade by going through microfiche for months, looking for patterns. And could you see Gil Blake in Paul Tudor Jones' office trying to trade markets actively? It just doesn't work. So you've got to know who you are. You've got to find a method that works for you. So now we come to there's a Wall Street saying that even a poor system could make money with good money management. Now, if you ever heard that saying, forget it. It's one of the stupidest things ever said. Because I don't care how good your money management is, if you don't have an edge, you don't have an edge. You can make money with good. I'll talk about money management in a bit, but that itself is not enough. You have to have an edge. I'll give an illustration. If you were to ask 100 mathematicians, I'm going to Vegas, I want to play roulette. I've got $1,000. What's my that I want to risk? What's my best strategy? Well, they're all going to give you the same answer. Your best strategy, you got $1,000, put it all down on red or black. One time, win or lose, walk away. Why? Because those are your best odds. The longer you play, the more certain it is you'll lose. if you play long enough, the odds you lose it all are almost are virtually certain. So the thing is, if you don't have, because if you bet once, then you only have that 2.5% negative edge, but it gets bigger and bigger the longer you play. So if you don't have a positive edge, money management won't save you, and you have to have an edge. The other thing about the traders I interviewed is that they all have a method. And if you go through some of the interviews, you'll see in some cases they're very, very detailed in what they do, and so you really get a full sense of it. In other cases, much less so. They may be more intuitive or whatever, but they still have an approach. No trader I ever interviewed said, well, I just get up and I look at the screen, and if I have a good feeling about bonds, I'll buy them. I mean, it was never cavalier. There was always a methodology that was involved. And then we get to the concept here of hard work. A lot of people want to get rich, but in the markets, but don't want to do hard work. And the reality, if you look at these traders and if you go through the interviews, you'll see that they are inherently really hard workers. I use an example. I mean, there's many examples, but I'll take John Bender as a classic example. John Bender was a brilliant options trader. His interviews in Stock Market Wizards, and he basically has a very different type of approach to options, but it was an asymmetrically oriented approach where he would look for situations where he believed the odds of the market going one way or the other were much greater than would be applied by the option models. And for example, I interviewed him. It was before the market crashed in 2000s. I interviewed him in '99, and he was putting on. He was implementing a very large position in put position in the S&P, and in 2000 he made several 100% on his fund. And actually, I kind of know that because I personally invested with the fund. It was kind of probably the best, not probably, it was the best investment I ever made. Now, Bender was a true workaholic. He would trade primarily Japanese options, and so he would be up during those hours, and once he was up for the Asian markets, he'd stay up and trade European options, and very often would stay up and then trade US options, and you put that together, and it comes out to close to a 20-hour day. Which is crazy. And I should say here, I am not recommending this as a way to live your life. I'm basically saying this is just a reality, that these people who do so well in the markets, many of them really are ridiculously hard workers. And there are lots of examples I can give you, but that one is kind of a good one. This leads us kind of to a paradox. Now, why are people so drawn to markets? A lot of people are drawn because they think the markets are an easy way to make a lot of money. But I just told you, the irony is that successful traders tend to be very hard workers. So that leads us to a paradox. Let me give you the illustration here. Imagine going into let's put it this way. You wouldn't think that any sane person would think they can go into a bookstore and go to the medical book section, find a book on brain surgery, read it over the weekend, and believe they could successfully go in Monday morning and perform brain surgery. Again, no sane person would think that way. I'm sure you'll agree with that. Yet, how many people do you know who would think nothing exceptional or odd about going into the bookstore to the finance section, finding a book, How I Made $1 million Last Year or $2 million or whatever the number is, and thinking they could read it over the weekend and then go in and beat the professionals at at their own game. So it's kind of a paradox. Why in one case would everybody see clearly the person has to be insane to think that way, and in the other case, a lot of people think, hey, I could do that. And this is a paradox that does have a satisfactory explanation, and that is that trading, as far as I know, is the only profession, the only endeavor that the ranked amateur, someone who knows absolutely nothing, can go in and be successful initially just by luck. And it's not true of anything else. I mean, you've never played the violin, the odds of you going up in front of the New York Philharmonic and playing solo are zero. You never performed surgery, brain surgery, and you're going to go in because you read a book, the odds of you succeeding is zero. But in trading, you might be successful because there's only two things you can do. You can buy or you can sell. And some people are just going to be lucky at the beginning by picking the right side. So that possibility of being successful, even without any skill or edge or anything else, is what beguiles people into thinking that trading is a lot easier than it really is. Successful trading, that is. So it fools people because they can be successful without really having the edge or skill. But in reality, it's no different than anything else. To be successfully long-term, you can't survive on luck alone. You're going to have the edge or skill. Okay, here's a concept that a lot of people probably don't get or know or understand, and that's the idea that good trading is effortless. Now, some of you will no doubt be thinking, wait a minute, just 10 minutes ago I told you about how it's all hard work. Now I'm telling you it's effortless, which isn't. So there's no contradiction here. The hard work is in the preparation and the process. And I find this over and over. Traders, they'll spend, like the book I'm working on now, or the last book, Unknown Market Wizard, traders spending just going through tens of thousands of charts historically, spending the entire day, and like one trader from the book I'm working on now, for the first 10 years of his career, not only trading, spending every minute of the day glued to the screen and intense concentration, but actually then recording parts of those sessions and they were important, and then on the weekends and nights reviewing those. So just completely consummated with trying to find patterns in the markets and spending all waking hours doing it. So that's where the hard work is coming in the preparation process. But the actual trading should be effortless, because if this, and here let me give you, let me actually give you a perfect illustration. People sometimes ask me, how do I get these interviews? Well, one of the things I do is I tell the people I interview, look, I'm going to do an honest job here, and I'll let you read the chapter before I give it to the publisher. And if there's anything wrong or there's something that's problematic, we can discuss it and find a mutually agreeable edit to it. And I do that not because I'm a nice guy necessarily, but first of all, I think it's fair, and second, I think it's a way of making sure it's accurate, but I also want to put them at ease so that they're open. That's one of the reasons I've been fortunate to get a lot of people being very honest and open in the interviews, because I think they know that it won't appear in a printed page without their being able to see if necessary. And that sometimes blows up in my face. And in this particular case, there was this interview with a trader I did that was very eclectic. He went into things like Zen in trading and dreams in trading, things of that sort. And I thought it was an interesting interview. And I finished writing it up, and I sent it to him, and gets back a week later and he says, yeah, I read the interview, yeah. And yeah, it was very good, but there's a hesitation there. I'm waiting for the but. Well, the but is he was a currency trader and had decided to go into the consulting business and hired a business manager to consult with corporations on hedging their currency risk. And his business manager read this chapter with all these things like Zen in trading and dreams in trading and said, hey, this is not the corporate image, this is not the business image. And he nixed it. And so the trader said, hey, I'm sorry, but I can't use it. So I said, wait a minute, there's one little section of this interview that I really think is valuable. How about if I use it, I'll call you Trader X. And he agreed. And the conversation went something like this. He asked, have you ever read Zen and the Art of Archery? And I said, I think I missed that one. And he said, no, I'm really being serious here. And I'm going to quote him word for word here. He said, whenever there is effort, force, straining, struggling, straining, or trying, it's wrong. And that really captures a very important concept, which is, and I'm talking here not if you're a systematic trader. If you're a systematic trader, you're a systematic trader. But if you're a discretionary trader, if you're making decisions in the market, and things are just not going right, maybe you keep on doing the wrong thing. You're getting loss after loss. You're getting out. The market turns right after you get out. If just things just feel off, working harder is not going to work. The actual process itself needs to be effortless. When trading is going best, it's effortless. If it feels like a struggle, a strain, trying, then it's wrong. And so, okay, so if that's the case, and all traders hit those type of situations, what is the best solution? And the answer, I ask traders that, and I basically get one or two answers. One is, and the simplest one is, hey, just stop trading. In many cases, just close your positions, clear the books, take off, take. In some cases, they just take off a day. In some cases, it's a week. But take some time off, and when you're ready to come back, come in with a clean slate. So one way is just break the negative psychology period and the struggling period, and just clear the books until your head is clear, and come back when you're eager to come back and ready to come back, and maybe start smaller or whatever until things are going right again. So that's one answer. The other answer is cut your position size. I remember one trader, Randy McKay from the first Market Wizards book, who would trade sometimes very large size, thousands of contracts, said that when he starts losing, he starts cutting his position size. He said, I can go from 2,000 contracts down to 10 contracts. And that works because, of course, you have to be of a certain size to be able to do that. If you're a small trader trading warm lots, it's not going to work in terms of futures. But if you're a little bit of a large trader, you can always reduce your position size to the point where if you're losing, it's not going to do much damage. So that's another way to do it, and then to start increasing your position size when things are going well. This is I was watching a 60 Minutes episode a number of years ago, and the episode was an Alex Honnold, who's a free climber. For those of you who are not familiar with that, it's an insane sport, amazingly impressive, but totally insane. And what Alex will do, and very, very few other people in the world will do, is climb these sheer cliffs without any ropes. I mean, not even ropes for protection. It's one thing to climb without using the benefit of ropes to climb, but for protection. But this is the idea that you don't even have ropes for protection. And so yeah, he'll climb cliffs like the one you're seeing, 2,000, 3,000 feet cliffs without any rope protection. So the correspondent, Larry Logan, asked him at one point, do you get an adrenaline rush? And he looks at her like shocked. He said, oh no. I mean, if I ever get an adrenaline rush, something is horribly wrong. The whole thing should be pretty slow and controlled. And I stopped. I hit the pause button, went and got my notepad, and backed up and took that quote. And I used that quote actually in the next Market Wizards book I wrote, because it's just such a perfect encapsulation. I mean, he's talking, of course, about his sport of free climbing, but it applies to trading. You know, you don't want the adrenaline rush. I mean, if there's an adrenaline rush, just like in free climbing, something is wrong. You want it to be slow and controlled. If you watch professional, really good traders, there's not going to be a lot of testosterone and shouting and emotion. It's going to be quiet. It's going to be focused. It's going to be slow. It's going to be pensive. It's exactly the opposite of the Hollywood image. In any movie or TV show about trading, which is always completely wrong about what it really looks like. And it's understandable why it's wrong, because the true image would be deadly boring. It's not good visuals. But you should know, as a trader, you don't want the excitement. You don't want the emotion. You want it to be slow and controlled and not full of emotion. There was one of the interviews I did was with Larry Hite, I believe in the first Market Wizards book, and he talks about having dinner with a coffee trader who was a very aggressive trader, and you trade large amounts in coffees. For those of you familiar, it's a very, very volatile market. Anyway, Larry just told him about, he just described what he was doing and all of that. And the guy said, "Wow, it sounds awfully boring." And Larry, for those, he was the founder of Mint Management, basically a systematic, early systematic trend following. The first really successful at that time, big fund, getting to $1 billion, which was really big for CTA, and eventually sold his fund. But Larry answered him. He said, "Well, I don't trade for excitement. I trade to win." And by the way, and he told me that particular trader, he a couple of years later blew up completely. But that's the idea. The idea is, it shouldn't be, trading shouldn't be a source of excitement. That's the wrong motivation. So a number of years ago, I did a blog which was called Ask Jack, and people would write in questions, and I would write answers. I would select one question each week or whatever it was. I think it was weekly, and I would answer them. So one of the questions I got was, do you think it's possible to use self-suggestion to have neutral emotion while we have a position? And I saw where the trader was coming from, and I thought he had the right sentiment. And I basically said, yeah, I mean, I think you're on the right path, your idea. You do want to tame your emotions, but really there's a much easier way to control emotions. And I said, yeah, I've got like 3 simple steps that you could do. And all you got to do is the following 3 items. First, have a trade entry plan, number 1. Number 2, have a trade exit plan. And number 3, just avoid prohibited trades. And what are prohibited trades? Anything that's not in 1 or 2. So the idea is, if you have a plan and you stick to it, you can get rid of your emotions in that. So we come now to the idea of where emotions really get painful. And I like to use good examples. Paul Tudor-Jones' most painful trade. So this is back in a day where Paul's back on the cotton floor, and let me paint the situation here. For those of you who are into chart analysis, you'll get with the illustration well. So the cotton market this new crop, there's old crop and new crop. Anyway, the old crop, July, has been trading in a way where it's in a price space, and then one day it breaks down to a new low and quickly rallies back and into the range. And Paul looks at that and he says, "Oh, that's likely a bear trap." And for those who are not familiar, the idea of, and bear traps and bull traps, by the way, are good patterns to look for. They're basically failures of breakouts. And they, in my opinion, bull and bear traps, the failures of key breakouts are much more reliable than breakouts, but that's another story. In any case, so he has the situation, and he thinks that the market is wiped out, taking out the stops, and now it's going to run up. And he already has a position, a kind of a position, but because he feels strongly, he puts an order in to buy several more in the pit, several more 100 contracts, and then jumping across all the other traders in the pit is a broker who screams sold instantaneously, and that broker was the broker for the cotton merchant that owned most of the deliverable supply. And in that instant, Jones knows he's dead in the water, and so does everybody else in the pit. He tries to get out of his position, but the market's quickly limit down. He goes limit down for the next few days. By the time he gets out of that trade, because he's had a position that was too large, he's wiped out 2/3 of his equity, literally in that one trade. He comes to the brink of quitting the business at a very early point in his career. And he's obviously decided to stay, but sort of made a commitment to himself, and he said to himself, "Mr. Stupid, why risk everything on one trade? Why not make your life a pursuit of pleasure rather than pain?" And that leads us to risk control. Now, I know you've all heard it, a million times, but believe me, just because you heard it doesn't mean it's not important, you may know it, but may not appreciate it or utilize it sufficiently. In any case, Jones' story is a perfect illustration of lack of risk control. One thing I can tell you is that many more traders that I interview will say that when I ask them why have you been so successful, will give me some variation of risk management rather than the particular methodology they're using. Now, Marty Schwartz, I mentioned before, had a really good way of putting it. He says you have to know your uncle point. I guess crying uncle was when I was a kid, which is a long time ago, was a common phrase. I don't even know if it still exists, but basically, two kids fighting, one bends the other's elbow until he screams uncle to give up. Why uncle? I don't even know. But that the idea is, and Schwartz, my age, basically saying that you have to know when to cry uncle to the market. Now, Bruce Kovner, and Bruce Kovner is one of the probably most successful traders of the modern era, Caxton funds and so forth. When I interviewed him, which was still early in his career, he had, if I remember correctly, something like an 88% annual return over a decade or so. In any case, Kovner had what, in my mind, maybe, and I should remove the maybe. In my mind, I think really is the most important single sentence in any Market Boosters book. And if I was restricted to giving one sentence of advice, it will be this. And it's, again, quoting Kovner: know where you will get out before you get in. Now, the reason why that is so powerful is in one sentence, it captures 95% of risk management. Because if before every trade you put on, you decide, okay, if I'm right, the market should not go here. I'm willing to risk so many dollars on this trade. Therefore, my position size is X. And you stick to that. Then every time you put on a trade, you don't have to agonize. You don't have to worry. Basically, you've locked in your loss. I mean, of course, the market can have some report come out and it can gap beyond it. But excluding those situations, and if you don't, I mean, some things are completely unforeseeable, but those are rare when you get those. And if it's in a stock market where it's not so rare because you have earnings reports, if you avoid a position through an earnings report, unless you're willing to take that risk. But this rule will basically define your maximum risk approximately. So you don't have to worry, you don't have to decide. The other reason why the rule is so important is what's special about before you making this decision before you get into the trade. Because before you get in the trade, you have something that you lose instantaneously as soon as you put on the trade. What is that? Objectivity. Because before you have a position, hey, you're objective. You don't have a horse in the race. But as soon as you put on that position, everything gets colored. Something comes out negative to the position. Well, yeah, well, it's negative, but it's already discounted. You'll find excuses. You lose your objectivity. So that rule is extraordinarily powerful. Say, if you take only one thing away from this particular session, if you take that away, you will gain a lot. Effective money management doesn't have to be complicated. As I gave you the illustration with Cumber's rule. But here's another example. This is Bluecrest, and their model, Michael Platt's model of controlling risk. So they had a key multi-manager fund. And now when I interviewed them, I think the returns were mid-teens, which is not terribly impressive. But the point is, I mean, it's fine. But maximum drawdown of was something like 5%. And, it's not like the stock market, which can get maximum drawdowns of 50%. So you might have, so it's like a similar return to the S&P and a very, very small drawdown. How did he keep the drawdown so small? Well, I said it's multi-trader, including himself. And the basic rule that they start out at the beginning of the year, they can lose up to 3%. So before their equity is halved, and if they lose 3%, then they can lose another 3%. And if at that point, if they're down 6%, their equity is taken away for the year. So by doing this, he's limiting each trader to basically approximately a 6% worst case, actually a little less percent, because 3% times 3% compounded is less than 6. But the idea is limiting what any trader can lose. Now you may think, well, wait a minute, how are you going to get any returns if you limit it to only 3%? Well, that's the starting thing. If a trader gets ahead, they can risk more. So if a trader gets ahead eventually 30%, he can risk 33% before his equity's out. And it sets an asymmetric situation, which is a great concept also, by the way, is trading in a way where your downside is limited, but your upside has much more potential. And this is one way of doing it by being very controlled in the beginning until you have some sort of cushion, and then becoming more aggressive. And that's an approach. And also it's a way of one thing I've personally done, and I am not a good trader, and it saved me money, is, and I don't trade all the time, I should explain. I've always been busy doing other things. So trading, the occasional thing I do sometimes, I don't do sometimes. But whenever I start trading, I always start with a small amount. And if I lose it, I stop and come back some other time. So and it always controls how much I could possibly lose. The one danger people do, especially early beginning traders, is they may start with much more money than they should, and they can lose it all and basically knock out their possibility of having another chance. Then we come to the idea of discipline. There's, I'm looking at the watch. I want to leave a little bit of time for questions. So I'm going to skip some things here. Let me go to the independence. Michael Marcus, particular chapter 1 of Market Wizards 1. Marcus, by the way, was a phenomenal trader. he got a $30,000 account at Commodities Corp and eventually ran it up to 80 million. He basically said at one point, you have to follow your own light, and that's an important concept. Follow your own light. He said you could take the ideas of two great traders and put them together and get the worst of each trader. And interesting enough, he was talking about himself and Bruce Cumner because Michael actually hired Bruce Cumner, and for a number of years they worked in the same office. Probably the two best traders ever in a single office. In any case, the idea is really important that you have to not be, no matter how good the person you're listening to is, you have to stick to your own advice. If you start listening to other people, it'll just confuse you. It'll go wrong, I can guarantee you. You'll find that for experience. Confidence. Yeah, I ask people, when I watch interviews, I get frustrated sometimes because they don't ask what the obvious question is. So I said, if I'm doing this, I'm going to ask the obvious question. And one of the obvious questions is, hey, you made all this money. Why don't you just bank it? And the answer I get from somebody like Paul Tudor Jones says, well, I keep 85% of my money in my own fund. This is from a futures trader. Why? Because he thinks it's the safest place. His futures fund in his mind is the safest place. Monroe Trout, when it went better, said he basically kept 95% of his money in his own fund. So that just is a demonstration of confidence. And basically, it's also a good tell sign. If you are not confident, that's a warning sign. If you're confident in trading, that is a clue that maybe you're onto something. Losing is part of the process. So, people try to avoid losing. It's a natural human instinct. And I think of something like Linda Raschke, a short-term swing trader, said, she said, it never bothers me to lose because I know I will make it right back. Which sounds arrogant, but she wasn't being arrogant, but she's basically saying, look, I've got a process. I know it works over time. Part of that process is it's going to lose. It's going to lose, periodically, intermittently, but eventually, if I stay with the process, I'll have more winners than losers, in terms of more money made on winning than losing, and it'll be fine. So the idea is losing does not indicate that anything's wrong with the process. Any approach will have losses. It's a probability game. The idea is simply does the approach have the edge, and not does it avoid losses. And in fact, avoiding losses is a dangerous. Trying to avoid it excessively is a dangerous thing in a way. So Marty Schwartz, again, I like this quote. He said, I asked him, he went from being a losing trader to a massively winning trader. What changed? And he said, I became a winner when I learned that it was okay to lose. He said, what is the ultimate rationalization of a losing trader or somebody in a losing trade? And that is, I'll get out when I'm even. Now, why is getting out even so critical? Because think about it. If you get back to even, you could say to yourself, hey, I was not wrong. I did not make a mistake. And that need to not be wrong is what causes people to really have these big losses on single trades, which for many traders is the way they get knocked out of the game. Another important quality I see over and over again in traders is patience. There's a phrase in Reminiscence of a Stock Operator, which is a book, as many you may know, about Jesse Livermore, not by Jesse Livermore. Anyway, in there, the protagonist at one point says, there is a plain fool who does wrong all the time, and then there's the Wall Street fool who must trade all the time. And the idea is you want to wait for the opportunity. Very critical. Jim Rogers says, I just wait until there's money lying in the corner of the floor, and all I have to do is walk over and pick it up. And what he's basically saying, until it's so easy, so obvious that it's like taking money off the floor, he doesn't do anything. I think of another trader that I interviewed on Unknown Market Wizards, Amrit Saul, and I called that chapter the Unicorn Sniper. And it was a perfect title because he had certain trades set up, certain situations tied to events where he would make incredible returns on these individual trades, but in between really didn't have much and would basically just ended up wasting time and focus. And so his approach, he really trained himself to wait for those traders, for those great trades for his methodology. Being the unicorn, the great trades were not many of them. And sniper, just waiting as a sniper just for the perfect shot. So that's a good illustration of patience. And patience really has two sides of it. It's not only waiting for the right entry, it's also when you're in the right trade to be able to stay with it and not to be shaken out prematurely for whatever your approach is. And again, in reminiscences, there's a phrase, it was never my sitting that made the money. It was never my thinking that made the money. It was my sitting. Okay, I see there's like 9 minutes left, so I'm going to stop here to give you guys a chance to ask some questions, and we'll open it to questions.
Excellent. Thank you, Jack. Any questions for Jack? Please do put them into the chat panel now, and we'll do a Q&A. There were plenty of people asking about a recording. Is the recording available? And yes, the answer is that we'll send that out about 3:30 this afternoon. Look out for that in your inbox. Jack, who was your favorite all-time interviewee?
Okay, so you could tell, in most cases, you could tell my favorite interview of a particular book by the one I place first. Not always, but it's usually my favorite or one of my favorites. But the Michael Marcus interview in the first Market Wizards book is certainly very high up there as one of my favorites. The reason for that is, first of all, it's just blatantly honest interview, and he goes through all the times, all these incredible stories of how he got wiped out multiple times before and then he became enormously successful. So that whole narrative of his early years, I found, was just particularly fascinating. So that was one of my favorites. And in the New Market Wizards, again, the first chapter was Bill Lipschitz, a currency trader, and he had some just great stories about his experiences trading. So I find the ones I like my favorites are the ones where there are really just great narratives about.
Let's see. David asks, do you think it's more difficult now to outperform than it was, say, 10 years ago? And I'm going to extend that back to, 30 years ago. Does the challenge of trading change over time? Yeah.
So, hey, the markets have changed enormously. I mean, especially in my life, in my experience, and I'm an older guy, so I got in early 70s, and back then, we're talking, there was no electronic trading for decades. We were talking open pit trading, right? Computers, PCs were actually non-existent then, and even in the early 80s, just beginning. But you didn't have computer screens, you didn't have access to data. If you were technical, forget about intraday data. Even daily data, you would get a weekly chart by mail and then updated daily. So just ancient compared to what it is like now. Not to mention, nowadays we have, or for quite a while now, We've got giant quant firms, which have many giant quant firms with literally hundreds of quant PhDs that you're theoretically competing against. You have supercomputers. You have obviously AI now. So in the world, the markets have changed enormously. However, what is striking, as I do book after book, is that many of the lessons of being a successful trader don't change. And the other surprising thing is, and maybe that's not surprising because it's not surprising to me, because ultimately trading is one way or the other tied to human emotions, and human emotions don't change, haven't changed. So that's why a lot of the same principles don't change over time, even though the market's changed massively. The other thing that has surprised me is the last book I did on no market wizards, is the book we're working on now, which is still in the writing phase and will come out mid-year next year, is that the traders I'm finding have incredibly, in some cases, the best records I've ever encountered. So the extraordinary thing is, with all these changes and all this competition from massively staffed quant firms and everything else, there are still individual solo traders out there. And the book I'm working on now is on solo traders, as was the last one. There are solo traders out there that are just putting up the most incredible numbers I've ever seen. So it's still, apparently it's still doable.
Jack, somebody asked a question about AI. Given the technical nature of disciplined trading, have you seen anyone fully embrace AI going to be the new quant trader and able to do what the seasoned and successful traders are by learning the lessons you've shown? It's almost like, can you put all the additions of Market Wizards into ChatGPT and teach yourself to be the best trader? Or does it come back to what you just said about? Does it come back to what you just said about?
I guess
human emotion.
You could theoretically do that, and you would probably get pretty useful advice, given that I think the books contain a lot of very good advice. So you could. You still have to. It's one thing knowing what to do and being able to do it, right? So there's two aspects of it here. One is that you still have to develop the methodology. And while there are many interviews where there's a lot divulged about the methodology, and that's going to be particularly true of the book I'm working on now, it doesn't mean that you could just take that methodology and be successful, because those methodologies work for those traders. You won't be able to execute them the same way or have the same confidence or the same do it. So you still have to, you can know all the right things, but you still have to come up with your own success methodology that fits your personality and that has an edge. So that's, and the other thing is, I don't believe that anybody can be a successful trader. I think, like anything else, certain people have talents and they're good. There's some people who are natural traders. You do these interviews as long as I have, you really come away with it. Some people just have that, just like there are some people who are great at basketball or are great runners or great musicians or whatever. People have innate talents, and for some people, they have whatever it is about markets, they've got an innate talent for it, and not everybody will have it. So it doesn't mean everybody can get better at trading and maybe net profitable by doing all the right things. But still, in all, you do have to have some natural talent to be really successful.
Good question from Mubashir here. He says, thanks for sharing your wisdom, Jack. Curious to know how the wizards would go about trading in the current market environment.
Well, they would all go about it differently. They all use different approaches. Yeah, so that's one of the things, and it doesn't make a difference. And for many wizards, actually, market environments that are bad for a lot of people, like a bear market, actually lots of the people I interviewed, like for example, for many of the traders I interviewed, 2008 was a wonderful year. Yet for most people, it was devastating. So it really depends on the approach. But most traders, almost all the traders I interviewed, there may be some. There are some maybe that were mostly net long and would have a bias to being better, but for the most part, they weren't dependent on market direction, and their approaches, again, in this market or any market, would be different because their approaches are all different.
This is an interesting one from Brad. He said, do any of these traders ever say, I've made enough, and then ride off into the sunset to retire?
So, and that is a question about about trade people I've interviewed?
Yeah, anyone you've interviewed, have they ever sort of said, yeah,
okay. So I am finding, actually, oddly enough, I mean, the book I'm working now is different in some ways and in terms of the commonality of responses, but I'm finding a number of the traders in this book who've made large amounts of money have said, well, and actually they don't necessarily give up trading, but they said, okay, look, I've spent 10, 15 years glued to a screen. I don't want to live the rest of my life this way. And they might, well, I don't think any of them have stopped trading altogether, but they kind of shift and find a way to trade where they're only watching the market sometimes or devoting just partial time. And they just change their methodology. They're still involved in markets, but completely change their methodology. So they get away from this constant all waking hours focused on the screen. So I'm finding that is a common reaction. People are actually thinking, hey, there's more to life than trading. And that is, I'm seeing that show up actually much more in the book I'm working on than I ever have before.
Paul asks, from the market wizards you've interviewed, are the majority trend followers or contrarians?
There are some striking contrarians. There are two that come to mind very immediately. The first one is Jason Shapiro in the last book, who uses the market sentiment numbers out, and basically has a very contrarian approach. And he's very contrarian in everything that he does, as it comes out clear in the chapter. So he's one. And by the way, contrarian doesn't mean, well, not in his case for sure, that there's an uptrend and you're just selling into the uptrend. Okay, it means that he has a contrarian view in terms of when he's taking a position. If he's going short, it's likely a market that's going up a lot. If he's going long, it's likely a market that's going down a lot. But it's not the going down, up and down, which is sufficient. I mean, he's paying attention to the sentiment numbers, but he's also waiting for the market action to confirm that it's turned, and that's discussed in the chapter. But maybe the most incredible contrarian I've interviewed was a prop trader called Jimmy Baladimas, who was a prop trader for First New York Securities. In any case, I knew about him simply because my son was his first job out of school was he was Jimmy's trade assistant, and he said, "Dad, you wouldn't believe this guy." And he told me a bit about him. Anyway, so I ended up, so I knew he was for real, and I ended up interviewing him. And it was, if you ask me, the most different interview of any interview I've ever done. The most extreme interview is certainly Jimmy Baladimas by a mile. And my first sentence of that chapter, I believe, is Jimmy Baladimas breaks all the rules, and he does. And the first line of the concluding summary is something along the line, "Don't try this at home." And that is because I think anybody who trades like Jimmy, almost like, I would say 999 people who try to do what he does will go broke. And what he does, he is the most contrarian person I've ever encountered. He just always wants to be opposite of everybody else. So like when silver goes to $50, Who's selling it at the $40? Jimmy Valadimas. I mean, that's the type of trading he's doing. He's selling into these crazy wild rallies. Now, in some cases, a lot of cases, he's actually absolutely wrong on the move. He's fighting a long-term trend, and yet he ended up being very profitable. And even in months where, let's say, he's net short the S&P or stocks, he's very short, and the S&P's up, 4% or whatever. The month I traded was a good example. He ended up being like break even. How the hell did he pull that off? Well, because he's constantly taking small profits out. She's trading against his position. So if you go short at 58, stock at 58, and it dips to 57, he'll take some off, and then it goes up to 59. And he was so good at taking these small profits, trading around the position, that he somehow managed to break even or even make money on stock on positions he was wrong on in the long term. But that was his real skill. That's in my mind. That's why he got away with it. But he would essentially be fighting trends.
Time for just a couple more questions, and maybe these are single answers. But who's the greatest single trader in history? Asks Ted. He says, was it Ed Sequeira?
I don't. I would say. It's not a trade. Jimson, I would say the Renaissance track record, because of its combination of compounded returns over I'm talking about the original fund, not the funds they spun off that could take money, in which case it was quite different. But I'm talking about that original fund. The combination of a very long track record, immense compounded returns before fees. I mean, because you're talking about trading skill. They were taking enormous fees, like, 45% of profits and a high management fee. But the trading skill is in the pre-fee results. So those were like, 60%, 70% over 40 years or whatever the time period was, and virtually no significant drawdowns. That combination of cumulative return risk on large sums of money for a long period. If there's a better cumulative record out there for anybody, and it's not just Jim Sons alone. He had hired multiple people, so it was a combined. It was more of a team thing, really. But that record is in my mind just the best record that exists. Yeah.
Next one from Sean. Any suggestions and words of wisdom for emerging fund managers?
Yeah, I don't know the questions in emerging fund managers. It is a question. I don't know if it's for the terms of building the business or trading aspect of it. In terms of the trading aspect, an emerging fund manager, no different than the same advice I'd give to any trader. It's really not different. As far as a business, that's a completely separate area, and often what's best to build a business may not be the best type of trading necessarily. It depends on, again, who the investor audience is. That may vary.
David asks, what kind of performance analytics does FundSeeder provide? You want to talk a little bit about FundSeeder, Jack?
Yeah. So the performance analytics, pretty, a wide range of different performance measures. The ones you'd expect, obviously, like Sharpe ratio and Sortino's, and there are statistics which are not necessarily in other sites, like gain to pain ratio, both for daily and monthly, which is my own favorite measure. In the Sortino ratio FundSeeder, I would mention, and I don't think you want me to go to this tangent, but basically, I think everybody calculates the Sortino ratio wrong. The FundSeeder has an adjusted Sortino, which is nothing more than dividing the regular Sortino by the square root of 2. For technical reasons I can get into if you want, but basically the idea is that will make the Sortino comparable to the chart, And the reason the Sortino is important and better than the Sharp, from my mind, is because the Sharp penalizes upside volatility. The Sortino doesn't. But unless you make the adjustment that Funseater does, you're going to almost always end up the Sortino higher than the Sharp, even for traders who don't have right skewed returns. And that's because it's using all the data points when by only focusing on downside deviations, you're throwing out the data. So you need to make that adjustment. And Funseater also has like stuff like underwater charts and NAVs and things like that. So there's a pretty wide range of analytics. The analytics are good.
Brilliant. Jack, we're going to have to leave it there. Thank you very much for joining me today, and thanks to the audience. And
Sure.
They have some brilliant questions. And Jack, I'm going to forward those questions on to you in a spreadsheet later on today, and we can talk about how to respond to them, whether you want to incorporate them in a podcast with me, later this month. Fantastic follow-up questions from people. But thank you very much for joining me.
Got great questions. We do a Q&A session. We could use those questions for the Q&A.
Yeah.
And actually, I always prefer not to see them because I like to answer questions impromptu without kind of knowing them ahead of time.
I can tell you've been practicing for years. Brilliant. Thanks so much to the audience, and Jack Schrager, big thank you to you, and I'll speak to you soon. Thanks, everyone.
Bye.
Bye for now.